the global effect of the banking system or the financial system is that we try to pursue the most efficient economic activity. So that is the main purpose of the banking system. And why is there some regulatory framework? It's because like banks need to take some form of risk when they lend to people, and they have different lending practices. But we must make sure that these practices are not abusive and they don't lead to undue risk that can create difficulties for the society. So there's a regulatory framework in there. But we've talked about the banking side. We can also talk about the insurance side, where there's a strong like regulatory framework to ensure that the insurance underwriting process is ethical. So one example that we could discuss is in ethics is discrimination. So for instance, insurance is a discrimination activity. So you have several people that want to be insured, and they all want like different rates or expect different rates, and you need to pick which one of these individuals you will insure. But in doing that, you must ensure that the way you decide is ethical. So you cannot discriminate based on, like, for example, ethnicity or something like that. That would be unethical. So regulatory frame. Yeah.
If I may just, so when you say discriminate, not discriminate in the sense of discrimination, but in the sense that basically you have to pick and choose in a way, like which customers maybe fit better your service offer and such. And then you want to make sure, because I understood what you meant because you use the term discrimination, but in a way it's not discrimination in a way that, it's unethical. It's just discrimination in the term that I have to choose who do I insure or not insure.
Exactly.
And then the purpose of the framework is to make sure that the machine doesn't discriminate, as in discriminate. So we want to make sure that doesn't happen.
Discrimination is a loaded term in the sense that it looks like you're harming somebody by discriminating. But discriminating, if you look at the definition, it means like choosing between like different opportunities. But there's discrimination and there's like ethical discrimination. So there are ways to discriminate that can be deemed ethical, acceptable. So for example, if some driver is reckless and some driver is more safe, it's fine to discriminate based on your driving habits. But you cannot discriminate on, let's say,
origin or skin color or whatever other criteria that are protected by the Charter of Human Rights and Freedom in Canada. But most countries also have their charter against discrimination.
Exactly. So these wouldn't be acceptable. So like you have some regulatory framework that prevents you to discriminate against that. Or like also like going back to the banking system, there's some regulation that prevents you from taking loans that are much too risky for you and that you're very unlikely to repay. So for instance, when you subscribe to a mortgage, you need to have a minimal cash down amount, and if you don't have this amount, you need to subscribe to some mortgage insurance, because we want to avoid placing people in very risky financial positions that will lead them to or possibly lead them to financial hardship. So this is the role of the regulatory framework. It's to basically, the idea is that we want to protect people against adverse or unfair outcomes.
And sometimes I like spending. So sometimes it'd be good to protect me from myself in that kind of case. So basically, the framework is the rules in a way that you give to the machine. So it's the framework in which the machine will use the information to then provide either, a loans decision or insurance premium and such. Because insurance, I remember, I don't know if it's still like that because I haven't been 25 years old for a while. But I remember when I was younger, being under 25 was considered at risk because, you have less experience or more reckless drivers, higher chances, of getting speeding tickets and such. And then eventually, and so insurance company back then, like when you reach 25, you're like your insurance. If you have a good, if you drove safely and didn't have too much speeding ticket, if your file was clean at 25, you got a good rebate because then they consider you less risky. So that's basically the analysis that they did back then. I don't know now.
But yeah, I think that's if you could do it either through machine learning or conventional statistical techniques. But the idea is that if at a certain age you're charged less, it's because the data has spoken in some way. So when you did the statistical or machine learning analysis, you realized where that there's a pattern where at a certain age there are less policyholders that are filing claims, and that as such you can like decrease the premium. So it's like basically when we said like you need to convey simple conclusions from complex data, this is an example where you see the data speaks to you, and then you conclude that at a certain age, if you're a good driver, then you can possibly decrease the premium because people are take less risk.
If I'm not mistaken, like for example, where you live, not in the sense of discriminatory, but in the sense of like, is there a lot of accidents in your area? Is there a lot of car theft in your area? Also to evaluate, if you want to be covered for car theft, but your area is where there's the most cars stolen, like statistically, you're more likely to get your car stolen, so it's more risky for us to cover that. It's kind of what we see also, I guess, for housing insurance, because I know now because of climate change, flooding, tornadoes, like we see more and more of those. So insurance companies to kind of make their investment worthwhile, and also to be able to have the financial resources to support their clients, they're also raising their premiums.
Well, yeah, because the idea is if there's higher risk but you don't raise the premium correspondingly, then the financial company would be more at risk of financial distress, or even go bankrupt. So the idea is when there's more risk, premiums like must be adapted as such. And right now you talked about like global warming or climate crisis. Well, there's a very large effort in modeling, for example, droughts and fires and tornadoes and all these climatic events, because it's very important for insurers to understand where these risks are the most severe and understand like where you need to charge more for some risk.
It's kind of a way to share the responsibility in a way with clients. I mean, so if my house burned down, like the company has money to pay me, your house doesn't burn down, but you still pay a premium in case, well, yours burns down. So it's kind of a way of it evens out, I guess, at the end of, not at the end of the day, but at the end of the year, or to be able to have basically a sustainable model that allows to provide coverage for the clients.
And it also incentivizes, like, for example, if in some regions you're more likely to have floods or earthquakes, then you'll have less developers like building new homes in these areas. So it's a way to incentivize people to take economic actions that leads to less risk in some sense. So
build different, build somewhere else.
Yeah, as an example. But of course, sometimes your house is like located near the seashore. Yeah, so there's not much to do. So sometimes it's the government that, if there's no insurer that is willing to protect against these risks, the government could help filling this gap in the market by either providing insurance or maybe subsidizing insurance for these cases where you're kind of stuck there and there's not much you can do.
But they'll also do their risk analysis, I'm guessing. So it's
well, the government hires actuaries too. So whoever does it, you need some risk reward analysis to understand like what's the pricing you should use and etc.